Hi, and welcome to Chapter 14. Today we're going to be discussing mutual funds and exchange-traded funds. So some of the advantages and disadvantages of mutual funds is what we're going to focus on. We're going to talk about mutual funds' new similar cousin ETFs and investment trusts. We're going to talk about calculating mutual fund returns, classifying mutual funds according to objectives, selecting mutual funds that'll be right for your portfolio. So now, we learned in previous chapters that to make stock investing safer, you want to diversify. So, a way of holding a diverse group of stocks and bonds is, of course, to go out and buy a diverse group of stocks and bonds. But that's time consuming, that's expensive. It's a lot easier to buy a mutual fund, which is basically a pool of money that's collected from investors and then reinvested into stocks and bonds and other investments. So each investor owns a share of the mutual fund, and then the mutual fund uses this money collectively to buy an organized portfolio to represent what the investor's objectives are. Okay, so let's look at some how much money is in these investment companies. Okay, so we have almost probably today it's over $20 trillion in mutual funds, exchange traded funds, closed-ended funds, unit investment trusts. Um, there is a majority of households that have mutual funds, mostly because they're an integral part of 401ks and 403bs. Um, so most people don't have one mutual fund, they have several. Okay, so why should we invest in mutual funds? So let's talk about some of the advantages. Okay, clearly the first biggest advantage is instant diversification. So when you get the mutual fund, you're automatically diversified because these mutual funds are going to, um, one mutual fund will easily have 30 or more stocks in it. So it's a very easy way to diversify. Most mutual funds you can have, although some are unmanaged, most mutual funds are managed and you get professional management. So which means that the mutual fund is going to be run by someone who has experience in trading stocks and building mutual funds, who has an education in investments and finance, who has access to the best research at various brokerage houses. So this professional manager is hopefully going to manage the money better than you can. One fact to point out is that if you look at indexes and averages, they typically beat most mutual fund managers. But if you look at the unmanaged investors that buy and sell their own stock, most mutual fund managers beat the individual investors. So you have the indexes do the best, then the mutual fund managers, then individual independent investors, people who just making their own investment decisions. So that's why there's been a big push into putting your money into index funds without a management professional. Okay, minimal transaction costs. Now there is some transaction costs for buying a mutual funds, and there are some fees, but you're going to pay far less commission than if you were to buy and sell a portfolio of 50 stocks yourself. Liquidity, you can get your money very easily, just like stock. You could sell this in whenever the market's open. Flexibility, there are you know thousands and 8 to 10,000 mutual funds out there to choose from. So there's a lot of flexibility, a lot of different objectives, a lot of different types of portfolios. So there's almost as many mutual funds as there are stocks to buy. Service. Mutual fund companies come with a service company that can provide you with all the bookkeeping, the tax records. They can also give you banking features like checking accounts and debit cards. So um, the service is at a higher and higher level as these companies compete with each other to get your business. And you're not going to have to deal with any stockbrokers that might be too pushy or just might be bad stockbrokers or stockbrokers looking for commission only. So these mutual funds solve a lot of problems. And that's one of the reasons that they are so popular. And the majority of most retirement money is in these mutual funds. Okay, so let's look at this is a listing of sector diversification in the 10 largest holdings of Vanguard. So this is the Vanguard Windsor 2 fund. So, okay, let's see here. This is the fund versus the Russell 1000, which is the closest index to the fund. So you can see the largest holding here is going to be Microsoft, Bank of America, Pfizer, and so on. Most of these are household names in this area. So whenever you look at diversification, this is a pretty well diversified fund, even compared to the Russell 1000. But the Russell 1000 is 1,000 stocks. But this is, balancing their um, picking the best stocks they feel out of 1,000 stocks in the Russell 1000. Not all 1,000 are going to do well. So it's the job of the mutual fund manager to say, okay, out of these 1,000 stocks on the Russell 1000, I feel these 100 stocks are the best stocks on that. I'm going to put them into the mutual fund. But mutual funds are not completely without some disadvantages. Um, like I had mentioned before, most mutual funds have a lower than market performance. So Russell 1000, S&P 500, Dow 30 typically outperform the mutual funds that are based on stocks from those indexes. And that's why so many people have chosen to take index funds or mutual funds based on indexes that are non-managed rather than managed mutual funds because the returns typically are better, which is counterintuitive. You think that if an experienced, educated portfolio manager and his team could do, and her team could do better than the just the index of 500 stocks, costs. So there is some costs associated with investing in a mutual fund. And the biggest one is that there could be fees and loads that can get pretty expensive as far as how much you have to pay to compensate the company and the management team running the mutual fund. And of course, there are risks. They're not mutual funds. Um, they're diversified, but there's still some of the non-diversifiable risks we learned in previous chapters, like inflation, interest rates, and market uh, shifts that your mutual fund is going to face no matter what. Now, depending on the mutual fund will depend really on the risk, since mutual funds can specialize. They can be a generalist fund where there's just taking stocks from everywhere, or they can specialize in a country, in a type of business, in any number of ways that they can slice and dice a group of stocks together. Um, they can. So the more narrow you get in your mutual fund stocks, the more risks there could be. Um, Now, one of those big non-diversifiable risks is what if there's a market risk and there's a market crash? All mutual funds are going to feel this, and all stocks. The only way to really avoid a crash is to have all your money in cash or out of the stock market. But since market crashes really typically involve a year or less of market time, so in a 10-year period, there might be 1 to 2 years where the market is in crash mode and 8 years where it's in expansion mode. So typically when people pull their money out anticipating a market crash, they may pull it out 2 or 3 years earlier than the crash, and then they might miss 2 or 3 of the best years. And they get frustrated and put it in near the top as their FOMO kicks in, and then the market crashes and they lose a lot of money. So it's very difficult to time the market. That's why you can't really be afraid of these market crashes. They happen. And if you dollar cost average, like we learned in the previous chapter, you're going to buy more shares at a lower stock price than when the stock price is higher. So dollar cost averaging is the best way. Taxes are also a disadvantage. You have less control over the taxes. So if the mutual fund manager is going to buy and sell stocks and generate capital gains, you're going to have to pay tax on those capital gains, even though you didn't make the decision to buy and sell those stocks in the mutual fund. So there can be I remember there's a situation where the market, somebody bought a mutual fund, the market crashed, they lost 10% on their mutual fund or 20% in the mutual fund, and then they owed a tax bill. Even though they never made any gains on the mutual fund, they still own the tax bill because they bought it within a year where they sold a lot of stocks that made a profit. Okay. Um, so a mutual fund is basically a pool of money from similar investors that have similar goals. So you want to get an easy diversified portfolio, and you want to have some professional help managing those stocks and setting those goals. So each mutual fund should have um, a clear statement of what they're trying to do, what their objectives are. Now, um, so if we're looking at the value of securities in a mutual fund, this is how we value um, a mutual fund. So if the stocks in the fund increase, the value of the mutual fund will increase and each share will increase. Now, we'll go a little bit more into the dynamics of that, um, how that's done in a little bit. Now, most dividends and interest will be paid to shareholders. They could hold some back to cover some fees um, or reinvest. Uh, so shareholders receive capital gains distributions when the fund sells a security more than originally paid. So there can be money, more than one way to make money in a mutual fund besides just selling the mutual fund. If the overall price of the mutual fund goes higher, that's a capital gain that you get on the buying and selling the mutual fund. You also will get dividends and interest probably, and some capital gains distributions at the end of the year, which for most mutual funds, these additional money you get will be automatically reinvested in the fund. But it's not like when you get a capital gain distribution of the mutual fund, the value of the mutual fund goes down when they make the distribution. So you're really not getting um, your accounts basically going to look like the same value from day to day. It's just that you got this distribution, it was reinvested in, you know, barring no changes in the stocks in the mutual fund, you're not really going anywhere. But now you have a tax liability because if they pay you capital gains, you have to pay tax on that. Now these mutual funds are basically little companies. So they're set up as a corporation or a trust. Um, and they run like a little business. So shareholders will elect a board of directors. The fund is going to run by a management team. Um, each individual fund is going to hire an investment advisor to oversee the fund, and the fund's going to contract with a custodian, a transfer agent, and underwriter to manage the distribution and the financial workings of the fund. So you could see that all these people are involved in running a mutual fund. They all have to be paid, and that's part of the fees you pay when you buy a mutual fund. So it's important to really see what are the annual fees associated with the mutual fund and how much of this will drag down your return. So for example, if the stock market returns an average of 10% over the next 50 years and your mutual fund takes 2% of that return, um, you can see how you're really going to lag behind rather than if you had your own portfolio of 50 stocks, Okay. Now let's talk a little bit about let's just go. What a pooled investment is. So investors come together with their money, and when we say a pool, they all put their money together. So individual investors invest however much they want because a mutual fund can grow as big as they let it. So if more investors come in with more money, they just issue those investors new shares. So that pool of money can continue to grow, and then the mutual fund is going to take that money and invest it in any stocks and bonds it feels necessary. There are some occasions where mutual funds are um, the returns are so good in a mutual fund, they may get more money than they know what to do with. And in that point, they may actually close the mutual fund to new investors to sort of slow the input of new money because at a certain point, there are rules about how much money a mutual fund can buy, how much shares or ownership a mutual fund can have in any one stock that limits their potential. And it's one of the reasons some of the bigger mutual funds typically only invest in the biggest companies because it's a lot more money to get to that percentage. Usually, it might be 5% ownership as a limit, but that's why mutual funds can get pretty big. But if the mutual fund company wants to control the size of the mutual fund to make it a little bit more nimble, a little bit more flexible, they may cut off um, new investors for the fund at a certain point, and maybe even open up a second iteration of the fund for new money. Okay, so companies invest in the pooled money in a number of investors, and they do this for a fee, of course. So people aren't creating mutual funds for only your benefits. They create these mutual funds so they can make money off from managing the mutual fund. Now, the most popular by far are what we call open-ended investment companies or mutual funds. These are ones where it's open-ended, so you could, as much money comes in as big as the mutual fund can grow. So there's really no supply and demand aspects to the price of the mutual fund. The mutual fund just has a set net asset value, which is the total market of all the securities. So that's basically the total value of all the stocks inside the mutual fund, minus any liabilities. Usually there's not much. Divided by the total outstanding shares issued, and that's the net asset value or the value of the mutual fund. And that's the value that you see in your brokerage account or the value that you'd pay when you buy and sell a mutual fund. Now, tomorrow when the stocks go up, at the end of the night, they'll recalculate the NAV and you'll get a new price of the mutual fund every night. And there's no supply and demand aspect to it because shares will grow or shrink as money is put into the mutual fund or as money is taken out of the mutual fund. So there's no supply and demand in a mutual fund. However, with a closed-ended investment company that can't issue new shares, there is going to be a supply and demand on the price of the closed-ended mutual fund. So closed-ended mutual funds are a small percentage of the market, but they have this additional risk or potential gain that if more money is looking to invest in these closed-ended funds, when demand is great, the value of these funds will shoot up. When demand is not as good, the people will sell these closed-ended mutual funds and the price will drop because they're going to work the same mechanics as a regular stock. So even though it's basically they get a set of money when they first go public as a closed-ended fund, and that's the money they have to work with moving forward. So anybody that wants to get into the fund after it started has to buy the shares from somebody else. If nobody wants to sell, the share prices will go up until someone wants to sell, and you can buy someone else's shares. So not only do you get the growth of the underlying assets, you might even get the growth if the closed-ended fund becomes more popular. But a lot of times we can calculate at all times we can calculate what percentage the closed-ended price is above or below the net asset value of the fund, and that gives you an idea, because you may seek out to look to buy some of these funds that are undervalued, and stay away from some of the funds that are overvalued. Now, there are also these unit investment trusts, which are another fixed pool of securities that works similar. They're not as popular by any means, but they're there, and the unit investment trust. Um, Generally, most of these are with bonds, specifically municipal bonds, and they are just not as popular as an ETF, but they still do exist, and they still do have fees, and they're just another way of organizing your investment. So it kind of works like this. First, the investment company announces the formation of a trust, then advertises and sells the ownership and shares to brokers. And generally, there's a minimal investment requirement of $1,000 and a sales commission of anywhere from 3 to 5%. Um, and the remaining funds are invested in municipal bonds. So it's just a specialized vehicle. And the advantage of these investment unit trusts comes from the diversification that they can offer, just like a mutual fund. And many municipal bonds are relatively, um, some can be risky. So it's a little bit of advantageous to buy a collection of these municipal bonds into a unit investment trust. Now, a real estate investment trust is an investment trust that specializes specifically in real estate. So these real estate investment trusts are going to invest in some form of real estate. They might invest in malls, hospitals, shopping plazas, um, rentals, or land. And basically, if these, it has to be real estate related that these investment trusts operate in. So this is similar to a mutual fund where you're pooling your money, but the money is going to be used specifically to invest in mutual funds. I'm sorry, in real estate. Now, when they do pay dividends, they're not qualified. You pay full tax on the real estate investment trust dividends, and generally most of the income that these trusts make, they pay out to shareholders. So it's a good way to diversify into real estate and away from stocks and bonds if you want to have another element of diversification. And these are pretty popular today, where I'm sorry, 401ks will provide some sort of real estate opportunity. Now, hedge funds are something that's very risky, but there's a lot of mystique built up around these hedge funds because they're primarily utilized by very rich individuals. They don't follow, um, they're immune to most of the rules and regulations that mutual funds live under. So hedge funds are a pool of money that can do pretty much whatever they want. So mutual funds are heavily regulated and been around for at least 100 years. So they're heavily regulated, and since most average people have their money in mutual funds, the SEC is pretty involved in making sure they're safe and they follow certain rules. But hedge funds are a newer creation, and they are not regulated by the SEC. They can charge very high fees, where mutual funds may charge 1 to 5% fees or lower. These hedge funds can charge 20%. So well, 20% of the profits they make and maybe 2% of the assets. Um, and there's the Renaissance Technology Hedge Fund, which is right here close to campus, and they take anywhere from 5 to 44% on top. It's just the fund makes so much money, and because they do so well, the managers can really easily take a high percentage of the returns, because investors are always happy because they're making a huge amount of money. But you have to be careful. Since they're not so, other hedge funds may be a little bit more less lucrative or less straightforward to what they're doing. And Bernie Madoff, which you may have heard of, he ran a hedge fund, but was really a Ponzi scheme. So no one really knew exactly what he was doing, because hedge funds have a little bit more secrecy or privacy in how they trade. Um, Now, so the hedge funds can propose more risk because you're less protected by the SEC. You're not protected by the SEC at all, and but typically they don't look for the small investor who's going to pull their money out at the first sign of some weakness. So they're going to invest with accredited investors, which means that you're going to have a net worth of at least, um, in most cases, $1 million, that you can, you know, invest a significant portion of your wealth into the hedge funds. So some hedge funds may have a minimum buy-in investment of $1 million, but certainly they generally don't go less than 100,000. Now, it's hard to really complain too much when that these if you're making 30% returns on your hedge fund as a rich individual, you're probably not going to complain too much that the mutual fund manager is getting 2% of assets or 30% of returns, and that it's not so regulated. So as long as things are going well and you're making a lot of money with your hedge funds, and typically the most successful hedge funds are turning people away. They're not taking new money. But again, this is something for the extremely wealthy. The average everyday person is not going to be involved in these hedge funds. Now, if we talk about the ETFs, which we're going to talk more about, they are like a mutual fund, where they're going to trade a portfolio of individual stocks or bonds um, on an exchange, but they're a hybrid, I'd say, between stocks and between mutual funds. So mutual funds are, they don't, their price doesn't change during the day. They get recalculated at night. But ETFs trade more like a stock, so their price is going to be displayed during the day, and the changes in the price will be displayed during the day. And you can, unlike a mutual fund with the ETF, you could short the ETF. You can do a lot of almost all the same things you can do specifically with a stock. You can do in an ETF, because it trades more like a stock. Which your mutual fund doesn't trade like a stock. It trades like a mutual fund, which means you don't know what the price is going to be until it values itself at the end of the night. So you can't do, it's not a day trading. You don't day trade a mutual fund. You can day trade an ETF to make some profits. And also, mutual funds typically do have some guidelines about, if you buy the mutual fund, there's a certain amount of time you have to wait before you could sell the mutual fund, or otherwise you might get additional fees. Um, So a mutual fund is not set up for day trading or short-term trading. It's a long-term investment where the ETF could be a little bit more of a quicker turnaround. All right. Now let's let's just go back for a second. We're talking about these ETFs. Um, Typically, a lot of the ETFs are unmanaged, meaning that it's just a group of stocks like an index. So, or they're managed with a much lower profile. So they typically have much lower annual expenses, um, and you're still going to be paying a trading commission. So when you buy and sell a ETF, you'll be paying the same commissions if you bought and sold a stock. But they're more tax efficient than most mutual funds because when you buy an ETF, the ETF would say, these are the 30 stocks we're going to buy for this ETF, and that's it. We're not going to buy or sell. We're not trading these stocks. It's a stagnant pool of exchange traded funds. And that means you're only going to pay taxes when you buy and sell the ETF. You don't have to worry as much about capital gains that the mutual fund manager may generate. So they're more effective or efficient for tax planning purposes. Um, and the ETFs can be a lot more narrow. So the ETFs are really can focus on a particular sector, industry, or country, and be a lot more narrow in the grouping of stocks that they pick. So typically, if you're going to invest with ETFs, you may want to have a bunch of them to get a little bit more diversity. Now, because they're so narrow in some of their focuses, they tend to have much higher returns if that just happens to be the sector or the country or the industry that's doing well that year. And investors can easily move their money around during tradable hours, where with mutual funds you have to wait to the end of the day to get your money out of the mutual fund, and then the next day reinvest it somewhere else. So here's a comparison of mutual funds versus ETFs. So how they're traded. A lot of the stuff we went over this before. The mutual funds are traded once a day, so you only know the price after the market closes and it calculates the NAV, and then you're going to be placing your order, but the order is not going to execute until the end of the day. Where ETFs are going to trade continuously through the day, and price is going to be based on supply and demand of investors buying those ETFs. So two different, extremely different ways of trade. Most money is still in mutual funds, which is today closer to 20 trillion, and ETFs are quickly growing though. They're growing faster than mutual funds. Now, mutual funds, their fee structure is a little bit more complicated. So the commissions can be different types of loads, a front load, a back end load. And commissions can be pretty high sometimes, going up to, here it says 8.5%. Um, there's also annual expenses with the mutual funds to help pay for the management company. Um, where in ETF, there's a brokerage commission you have to pay like a stock when you trade the exchange traded shares. And then the annual fees are much lower um, because they typically tend to be unmanaged. Now, as far as transparency, the holdings are reported only a monthly or quarterly basis with mutual funds, but the ETFs, the holdings are made transparent on a daily basis, typically on their websites. So, what are some advantages of ETFs? Well, uh, of course, the trading flexibility is a big advantage where you can buy and sell them intraday. ETFs can be sold short or bought on margin, which is something most mutual funds can't do. Definitely can't short a mutual fund. Um, ETFs allow you to take instant position in a sector or country or an industry. You have very low annual expenses because typically they're unmanaged, so there's no management fees and there's no um, most of the fees that a mutual fund can charge you, an ETF doesn't or can't charge you, and they're much more tax efficient. So ETFs are the ETFs can also be a little bit more specialized with the mutual fund, where they could utilize leverage inside the ETF to be 2 times, 3 times the market returns, or they could ETFs can be all sorts of specialized types of trading strategies built into the ETF as well that can help you in different market situations. But the big disadvantage of ETFs, because they trade like stocks, you got to pay a brokerage commission every time you buy and sell. But a lot of times these commissions today have been minimized to under $10 per trade. Um, Now the ETFs are not traded at their NAV, the net asset value, so there's supply and demand element to their value of the of what the price you'll pay for the ETFs. Um, And if you trade these ETFs very frequently, the costs do ring up. So they can be more expensive than a mutual fund because you're paying brokerage fees every time you buy and sell the ETF, plus any tax liability you may have when you make a profit with these ETFs. So ETFs, a real downside or disadvantage is that you might be tempted to trade them more like day trading and trade too frequently with them, and that's going to chew through a lot of your value. Now let's calculate the mutual fund costs and returns. Um, okay, so let's look at load versus no load funds. So a load is a commission charged when you buy or sell a mutual fund. So it's the load fund is a fund where you're going to have to pay, the load is going to be charged. So there can be a front end sales load, which basically means that if it's a front end, um, you're going to be paying in the beginning. So with a back end load, you're going to be paying when you sell your shares. So typically, if there's a 5% load fee, you pay 5%. So if you buy $1,000 worth of the mutual fund, you have to give them $1,050 for the 5% front end load. If the back end load is when you're going to be paying when you sell your mutual funds. So sometimes the back ends, if you're anticipating to make a lot of money on this mutual fund, the back end can be more expensive than the front end. The So they also could break the shares up in the mutual fund into different classes. So class A, they typically have the front end, um, which are paid again when they're purchased. The class B will typically have the back end, which are paid when the shares are sold. And there's the class C where you pay both the front end and back end of the fees. Now, a no load fund is a fund that's not going to charge any commissions to buy and sell the shares, which is what most people prefer. And because most people prefer these no load funds, most mutual funds today are no loads because people don't like the fact that I want to buy $10,000 in mutual fund and then suddenly there's an extra $500 charge for a load, or have to sell their mutual fund and then pay some of their profits back as a load. So these are very unpopular with investors, and many mutual funds have strived to do away with them. However, management fees and expenses, all mutual funds are going to be charging these. So there's a lot of money cost in setting up and running a mutual fund. You have all these people who work for the mutual fund that are going to take care of the bookkeeping and the marketing and the advertising. And that's not to mention the advertising expenses. They have to advertise the mutual fund on websites and in newspapers and on TV. It's a lot of money to advertise. So that's going to be another part of the expenses. And then you have to hire portfolio managers and research teams to manage and research and trade the mutual fund. Those are all more expenses. So there's a lot of management fees and expenses, and it's one of the reasons that mutual funds are not as desirable as individual stocks, because you have to pay these continual fees all the time. So these mutual funds are going to run up big expenses, as services costs for the costs they're going to incur as being the investment advisor, the custodian, the transfer agent, the underwriter. So the sales commission on the securities, the operating expenses, legal fees, and so on, these are all going to be, have to be paid for and can be part of the, expense ratio. Um, so there's a lot of moving parts and a lot of people, a lot of companies involved in bringing a mutual fund to market. And as the investor, you're going to have to pay that. So the good news is usually these mutual funds are so large and so much money is involved that these expenses can overall be low. Um, a low percentage of your total investment. And that's why you want to seek out and invest in funds with a low expense ratio. So when you look for different mutual funds, there's probably dozens that are going to fit in the same category or subject or investment strategy that you're looking for. Compare the expense ratios among them to see which has the lowest expense ratio. I mean, you're definitely also gonna want to compare the returns of these different mutual funds. So if one mutual fund has a higher expense ratio, but they have a 4 or 5% on average better return, then that's a good trade-off, a fair trade-off to make. Now, the turnover rate measures the level of the fund's trading activity. So when they buy and sell stocks continuously, this turnover rate does create more expenses and capital gains. So this is something that you might want to compare between different mutual funds is what is their turnover rate percentage. The lower the turnover rate, generally the less costs associated to you. However, some managers may be very good at trading stocks, and even though they have a higher turnover rate, which is not that great, but if their return is 2 to 3% higher than the competitor mutual funds, then definitely it's worth dealing with a high turnover rate if these mutual fund managers can deliver. So just because the higher turnover rate results in the higher funds expenses because of trading and commissions and taxes, as long as they're getting enhanced or superior returns, that's what you have to look at. Now the problem is you're paying for management to manage your fund and trade and make you better returns. The problem is the managers don't always stick with the same funds for long periods of time. So if a fund did great for the past 3 years under one fund manager, the time you buy it, he may have already moved on to another fund. So sometimes it pays to investigate who the fund managers are, who the most successful fund managers are, and try to um, trade the portfolios or mutual funds they're working on as a way to enhance your returns. So there's a lot of, like I said, there's a lot of moving parts here. One fee I definitely want to talk about is the 12B-1 fee. So they're trying to make the name really boring so people don't look at it too closely. But this is basically um, um, uh, something. It's related to marketing expenses. So this is one thing that mutual funds have a lot of expenses. Is they have to order. The game of the mutual fund is to make the fund big. So the bigger the fund is, the more money the company will make, the more money they can use to manage the fund. So they want to advertise the fund, and they want to promote the fund, which could cost a lot of money, and you have to pay for that. So even though you're invested in the fund, this advertising promotional isn't going to really benefit you. It actually might be a detriment because the bigger the fund gets, the less nimble the fund is, and usually the harder it is to get the same level of returns. But all these fees for advertising gets passed on to you as a 12-B fee. Um, and these fees can go up to 1% annually, and that's a lot of your return taken out just for them to advertise the fund. Um, and they don't really benefit you directly because the bigger funds are not going to be better for you. They only really allow the fund manager to pass on, the fund expenses to you. So 12-B is not a great fee, and you definitely would want one that's, closer to 20.25 percentage of a 1% rather than the full 1%. So most of these fees go to the brokers and the banker trust departments. Not, you know, they're they can be, even though they should be for marketing and promotional, they can be moved around a little bit. So it's sort of just like another way to slap an additional fee on your mutual fund. Um, Now, studies have found that funds that charge these fees have higher expense ratios but don't exhibit any better performance. So the 12B-1 fee is usually hidden. You have to look for it. You may have to ask about it. It's going to be there somewhere, but it's not front and center. So it, you're not going to get any value from this fee. It's not going to enhance your returns. It's really for the betterment of the company that runs the mutual fund. Um, So let's calculate some mutual fund returns. So you buy your mutual fund and you want to know, okay, what did I make? What were my returns? Well, it gets a little complicated because there's a lot of things to take account for here. So we have capital gains, which is the change in the asset. We have, you know, um, fees. We have um, interest and dividends. Now, most mutual funds, when they pay you a capital gain or interest or dividend, they reinvest it directly back into the mutual fund. And so if you calculate your returns, you're going to have to um, factor all these in on the calculation. So here's the basic calculation. We're going to take the dividends, we're going to add it to the capital gains, and then we're going to add that to the difference between the ending NAV and the beginning value of the NAV, and then we're going to divide it by the NAV. So this will basically give us our return. So again, what we're doing is dividends are part of the return, capital gains are part of the return, and the capital gains are distributed. That means that the mutual fund manager pays them out to you. And then looking at the beginning and ending value of the mutual fund, which is what the ending NAV, the beginning NAV is, that gives you your capital gain if you sold the mutual fund today. Divided by your buy-in price beginning NAV, this gives you your total return. So you could calculate it. It's just a few different steps, but you want to get this total return to see what percentage you really made on your mutual fund. So if we look at the different costs of these mutual funds, okay, we talked about the no load funds. So we typically like funds that aren't going to charge us a load, because load funds, they can be, you know, a large percentage of your total invested dollars. It's not, you're not paying loads on the gains, you're paying loads on everything. Front end loads, you're just paying on the amount you invest. The back end load, you're paying loads on your investment and the gains. Um, so we do have these classes where class A are front end loads, class B are back end loads, and class C have higher annual fees in some cases, um, but maybe no load. Now, the management fee is the fee paid to the fund's advisors. The expense ratio is the fund to pay for the expenses of the fund, and the 12B-1 fee is supposed to be paid for the marketing fees to be passed on to the investors. Now, let's switch gears here to love and money. So we talked about previously in other lectures that money is a key aspect of all relationships. So um, more financially successful couples have less monetary pressure, which really can result into less relationship pressure. So studies have shown that the more money spent on engagement rings and weddings could be correlated to the higher risk of divorce. So because expensive rings and weddings puts more debt on the couple, puts the marriage in more of a debt stance, and if they go to buy cars and a house, and then basically they wind up being in a position where, yeah, we have everything we want. We got the big fat wedding ring, we had the $100,000 wedding, we have the $500,000 house, and the two $50,000 cars, and now we're having some kids. But this all comes with a crippling amount of debt and monthly service that has to be paid, and that puts an extreme amount of pressure on the couple, that both people have to be working, and if one person doesn't work, it's all the stress and of supporting the whole families on one person. This is sometimes too much for one person to bear. So this consumer debt increases the risk of divorce. So financially smart people that manage their debt well and have more financial leeway with their more income versus their expenses have a little bit more stable of a relationship. Um, just as something this book likes to point out. Okay, types of objectives of mutual funds. So mutual fund managers can classify their funds. First, you want to figure out, what are your objectives, and then try to figure out a mutual fund that's going to meet your objectives. Now, let's talk about the money market mutual fund. These are very safe, short-term um, places to park your cash, usually 30 days or less, to make a little bit better return than say a savings account. And typically these money market funds have the lowest amount of loads and fees, and they try to maintain a NAV close to $1, which is very rare that they break that NAV, although sometimes they can come close to it, like they did in the 2008 financial crisis. Some funds were worried about that. By and large, most of them that didn't happen. So they have very minimal expense ratios, but even after the expense ratios, these money market funds are going to return more interest to you than, say, a bank account. And they can be a tax exempt money market fund that's going to invest in munis or government securities. So there are a lot of different types of places where you can temporarily park your money to get better returns. Now, most of the mutual funds are stock mutual funds, and they could be broken down into these 7 categories, which would constitute just about all the funds. Aggressive growth funds. These are buying stocks that are hot, that are greatly increasing in revenues and in earnings, and they're growing fast. So these aggressive growth funds are going to seek out these really hot, fast-growing stocks. Um, Small company growth funds, these are mutual funds that are going to look for small companies that are growing fast. Growth funds are just looking for not the hottest stocks out there, but stocks that consistently are growing. So where the aggressive growth funds may be looking at stocks that grow at greater than 25% their revenues every year, the growth funds might be looking at somewhere between 10 and 25% growth of their revenues. Growth and income fund is sort of mixing some income bond elements or dividend paying stocks to produce an income with some more growth oriented stocks. So sort of make a balance, a little bit more diversified, balanced mutual fund. Sector funds are looking to invest in sectors of mostly industry. So technology, um, oil and gas, healthcare, like just buy stocks of a similar business model as a sector. But sector funds can also be anything you could classify as a sector. So, there could be other things in there as well. Index funds, these are funds that are mimicking indexes. So the S&P 500 index is just the index that's run by, um, a company that just puts out the numbers and publishes them. There's no money in that. But index funds will take the stocks in the same proportion that they're laid out in these indexes or averages and create a mutual fund out of it. Since these indexes perform better than the mutual fund managers and these index funds have lower fees, they're very popular, and that's where most people's money are. And of course, there's international funds, and these are funds that are based outside the United States, or it could be in a single country or a region like Asia or Europe or just the world. So, because typically diversifying means owning stocks throughout the world, not just in one country. Um, so here is for the total assets in mutual funds at the beginning of 2016, and it says roughly the same today, even though it's been a few years. Most are in equities. And equities are stocks. About a quarter is in bonds. 17% is in money market, and 8 is in hybrid. So hybrid is a combination of any of these three. It could be 2 or 3 elements together. So let's talk about a balanced mutual fund. So tries to balance the objectives of long-term growth, income, and stability. So a balanced fund is basically going to hold stocks and bonds and sometimes preferred stock, and they're trying to make a steady balance of income and capital gains, and just be a more diversified, safer, longer-term investment, great for retirement accounts. Um, and the mutual fund managers can play with the ratio of stocks to bonds depending on the overall forecast of the market. Um, so they're aimed for the needs to people who want to live on some income but also want to have some stability and growth in their investments. And they can typically be less volatile than other mutual funds because they include a bigger um, range of investments within the fund. So asset allocation funds is similar to the balanced fund and invest in a mix of stocks and bonds and money market securities. And these funds are more balanced in the asset allocation of the funds. They move between stocks and bonds in an attempt to outperform the market. So they're going to want to shift. So if stocks are hot, put 80% of this fund in stocks. When bonds are doing good and stocks are poor, put 80% in bonds. And in the rare cases where bonds and stocks are both doing poorly, maybe move most of the money to a money market. So just give more flexibility between what sector, and hopefully your mutual fund manager in this asset allocation fund is skilled at knowing what sectors are coming up, what sectors are going down, and be able to move the money between those sectors. But there are additional fees and expenses when you move money around so rapidly. Now, a lot of people don't want to have to manage their mutual funds, meaning that, okay, I'm at this age, I want to buy this set of mutual funds, and as I get older, I want to switch to this group of mutual funds. It can get to be a lot of work. So they develop these cycle funds or targeted retirement funds, which are mutual funds that are going to, modify their holdings based on your age, and they're going to grow with you. So if you're going to retire in 40 years, you can get a mutual fund that will say target retirement 60, 63 or something like that. So you're retiring. And as you get closer, it still says the retirement target of 2063. But as you get closer to that retirement target, they're going to move your money automatically away from riskier stocks into safer money markets and bonds to shield your money from capital losses and stock market crashes as you get closer to retirement. So these are a great way to put all your money in one fund and not worry about it. Although, because there's a lot more management involved, these funds will charge higher fees and expenses. And that's the one downside of these funds. But a lot of these funds are quite popular with a lot of people that don't want to put any effort or thought into what they're doing and just want put all their money in one fund and set it and forget it and never think about it. And they're very popular in retirement plans or in 401k managed types of funds. Now, there's also bond funds. So mutual funds that are specifically made up of bonds, and bonds are their own type of world, which we discussed in the previous chapter, and interest rates and inflation affect bonds. Um, so in the bond fund, the managers are going to have, depending on the scope of the bond fund, they can decide where and what type of bonds they want to invest in. Some bond funds are only for municipal bonds, some are only for treasuries, some are only for corporate bonds, and some can be a mix of all of them. So typically, there are a lot of municipal bond funds for people who want to they're in a higher income tax bracket right now, and they want to avoid taxes on their income. So municipal bonds. Corporate bonds might be for people who want to have higher returns. So corporate bonds typically provide higher returns than municipals and treasuries, but are a little bit riskier. So, and bond funds can be at different maturities. There could be short term, intermediate term, and long term. And the thing about these bond funds is the shorter the term, the less interest rate risk they'll take on and the safer they'll be. Now, as far as mutual fund services, mutual funds want to, service the customer as completely as possible. So, they can give you automatic investments and withdrawal plans. Automatic investments as you're building up the mutual fund, they'll just take $1,000 out of your checking or savings account every month, and then when you retire, they can give you automatic withdrawals, where they just add money back to your checking account. There could be automatic reinvestment of interest, dividends, and capital gains, and most mutual funds are set to automatically reinvest. They give you the option to move your money around, whether you want to transfer it to a bank account or you can wire the funds, or if you want to some mutual funds will even have a debit card where you can withdraw funds on their branded ATMs. All mutual funds will have online and phone services. Most mutual funds will work easily with retirement and 401k plans. They can give you a checkbook, give you check writing. They will give you detailed annual summaries and tax help and ability to download tax information to say TurboTax. So these mutual fund companies want to be full service. And if you get a lot of brokerages operate their own family of mutual funds. So if you get a Fidelity or a Charles Schwab, they're going to have their own family of mutual funds that are combined with their brokerage accounts. So if you have a brokerage account with Fidelity or Charles Schwab, you can put your money in their mutual funds and have all the additional services of a brokerage as well as a mutual fund, and have pretty much anything the bank can do, these funds will be able to do as well. So you can keep everything in one portfolio or one account. You get your brokerage account, and in your brokerage account though, so if you have a Fidelity brokerage account, you can also directly buy mutual funds from other companies, and they'll all be housed within the Fidelity brokerage account. Okay. So here's some steps in buying a mutual fund. So you want to invest, you're not ready to buy individual stocks, so you want to put some money in a mutual fund, you have some extra money and you're hoping to get some good returns. So step one, how long do you want to invest for? Why are you investing? Is it for retirement? Is it for just making money? How big are taxes are an issue, and how much risk can you take on? So these are what you want to know before going into buying a mutual fund. And then you want to look at your objectives. What are your objectives? So here are some websites that you can get some more information about mutual funds to help classify and turn your objectives into actual funds. So there's a lot of different mutual funds, a lot of different classifications. There's money market, stock, balanced asset allocation, life, style bonds, I'm sorry, life and bond funds, and each of these classifications, a lot of different subclassifications, a lot of different sectors, growth, income. So there's a lot to really look at. And like we said, there's almost 10,000 of these things to really investigate. So more than you could ever really get to look at all each and every one of these individually. That's why there's a lot of these mutual fund screeners, where here's a couple different websites where you can go in and identify, click a few boxes. This is what I'm looking for. I want to only invest in ETFs that are stock, that are based on growth, and they'll start putting lists together for you and then some of them will even provide rankings of how safe they are, or how, what's the risk levels, and you can get a lot more additional information about these different funds from these websites. And that's your research. So when you're meeting your objectives, you definitely want to do your research. You know what your goals are, and you have a better idea of what mutual funds can meet those goals, and that's how you're meeting your objectives. But you got to do a lot of research and work in that field there. And then you finally get to the point where you select a fund. So when you're selecting a fund, you narrowed it down. Here are 20 funds that fit my objectives and can align with my goals. Which one should I pick? I only really need 2 of these 20. Well, you want to evaluate past performance. Have these funds done well in the past 10, 5 years, 3 years? That doesn't mean they're going to do well moving forward, but it definitely is of some value. And you want to look at the costs. What are the overall cost differences between these different funds? And in the end of the day, the mutual fund might actually be called a dividend fund or income fund, but really look at the stocks that these mutual funds own. Are they really meeting your objectives? Because in many cases, I've had mutual fund which I thought was a safer mutual fund investing in dividend oriented companies, only to find out that the mutual fund managers steered away from some of these objectives and were buying much riskier internet stocks that paid no dividends. So you also want to always double check and see what are the rules about what the mutual fund manager can buy. Are they doing window dressing or trying to shop around the hottest stocks to boost up their performance in the mutual fund, but at the same time giving more risk than you're comfortable with? So there's a lot of investigations you have to do there to make sure the fund aligns with its objectives itself. Now here's a checklist before buying a mutual fund that you can kind of look at. So check out the fund's performance, the expenses, the risks that they outline in the fund, like their perspective on these mutual funds will outline the risks associated, what type of securities they actually hold, and is this how often does this portfolio change, and is this what you expected them to own? How do they compare to other funds in the same category? Are they top or bottom? Like, what's their percentage rank of return? Um, Look for other websites that will evaluate and rate these mutual funds. Um, and just make sure you know your loads and your fees and your 12-B fee, and also how tax efficient is the fund? What is their turn rate? What is their capital gains payout ratios? Things like that. Now, a good place to get all this information is in the mutual fund prospectus. So this is a book that they're going to give you that's going to outline the goals and the strategies of the fund. It's going to introduce you to the mutual fund manager and maybe give you some information about their past and what they've done or how long they've been on this mutual fund. Should outline any limitations they have, things the mutual fund can and can't do. What the tax implications are to investors, are how much income that investors had to pay tax on for each year. What's the process for buying more shares or selling your shares? Some funds will have a penalty if you sell within a year, or if if you sell within 90 days. So, and some funds may actually bar you from selling the fund within X amount of days. So you want to know what these redemption policies are. What services can they provide you as far as support, information? Do they have a live person you can talk to? Definitely check out their performance in the 10-year, a 5-year, and a 3-year period. Know what their fees and expenses are so you have a good idea of how much the fund's going to take out of the overall return. So if the fund can get a 15% return but take 6 back in expenses and fees, may not be the best fund for you. and then give an idea of what the fund's actual turnover rate is. How much trading are they actually doing? And usually a lot of trading could mean changeover in fund management or fund philosophy, or seeking to get window dressing, which is buying stocks that are going to look good at the end of the quarter, but might necessarily really help the return of the fund. So it's all about images. Okay, so to get a typical quote on a mutual fund, how you would do this is, again, same place, any place you can get a stock quote, you can get a mutual fund quote. And it's going to be very similar, where the only difference is that you're going to get, for an open-ended mutual fund, you're going to get, of course, the name of the mutual fund and the stock symbol. Mutual funds have symbols like stocks do to trade. So when you trade in your brokerage, you have to know the stocks, the symbol, trading symbol for, like a stock has a trading symbol, like AT&T, the trading symbol is T. You know, then they give you the NAV as of a particular date, the change from the previous date, the year return, um, I'm sorry, the one-day return, the year-to-date return, and the category. So these different quotes will get you different things, but basically this is what the general information you'll get on the mutual fund quote. And again, here's the other screening criteria that we talked about before. Here's just a good checklist. Write down, compare fees between mutual funds. Compare the 12B-1 fee, because it can be a sneaky fee they add on top. Look at expense ratios. The total expense ratios, you want it to be, I would say, under 1%. What is the turnover rate and compared to other funds in that class? Because turnover rates will be different depending on what type of mutual fund it is. Growth funds have a higher turnover rate than income funds on average. Then check the Morningstar ratings. What is Morningstar? They'll produce a fact sheet and a rating on this mutual fund. What do they say? And they'll give it a rank as far as its position of all similar mutual funds. Look at the historical returns. Look at the Morningstar risk level that they'll give you. And Morningstar gives this stuff for free. Just go to their website. What is the initial investment? Some mutual funds may require $10,000 to get into the mutual fund initially. So this could be a limitation. And how long the management's tenure? How long has the manager been there? 3, 5, 6, 6 years or 6 months. That's important too. And you know, if the mutual fund manager changes, what is the new mutual fund manager's track record in history? You want to know all of that stuff. Okay, so finally, step 4, making the purchase. Well, probably the easiest way is to buy through a brokerage like Fidelity or Charles Schwab, are the two lowest cost, biggest, most well-established discount brokers that you can easily buy mutual funds from. And you can also buy mutual funds directly from the mutual fund company, but I don't recommend it because of the additional paperwork and tax filing requirements when you buy direct. Always easier to buy through Charles Schwab or Fidelity and have all your mutual funds and all your investments in one brokerage. Okay, to summarize this chapter on mutual funds and exchange traded funds, this is, a great investment opportunity, because when you're buying a mutual fund, you get a large portfolio with instant diversification and a little bit more investment that could be an easy way to align your goals with, you probably only need less than five or less mutual funds to have a well diversified retirement portfolio. There's a difference between open-ended and closed-ended mutual funds as far as how they trade and how money is brought in and out of those funds. Unit investment trusts and real estate investment trusts are other similar types of investments that work on the same principle of pulling investors' assets together to make an investment. Um, be knowledgeable of the fees and expenses that funds carry. Don't be caught off guard, because if a fund has a load and you're going to buy and sell multiple mutual funds within 1 year, you can rack up a lot of additional expenses and costs. And mutual funds are generally categorized by their objective, but make sure that the objective that they're categorized actually matches the stocks in their portfolio. And when you're selecting a mutual fund, make sure their goals align with your goals and the fund's going to meet your objectives. And I would say you probably should only look at your mutual fund once every 6 months, not every day, not once a week, but you set it and forget it. If you made the right, if you did all your research, you made the right amount took the right amount of time to get into your mutual funds, now you have to give them a chance to grow. So if you have 5 or 6 mutual funds you invested for your retirement in a 401k, keep dollar cost averaging, adding those positions week in and week out. And, again, don't check your portfolio too much because that may cause you to trade more than you should. But every once in a while, maybe every 3 to 5 years, you might want to realign or change your portfolio somewhat. And for most 401ks, you're going to have a management company who's looking at what they offer in the 401k portfolios, and they may actually discontinue some mutual funds that are underperforming and add some new ones that would be nice, better performing, better managed mutual funds over time. So there are other people also helping you with this. Plus, if you have it through a 401k, they probably offer you services where you can talk to investment advisors related to the, whatever who's ever managing the 401k. They can help you with deciding your retirement goals and needs and looking at, specifically looking at how your investments will translate into retirement income. Okay, I hope you enjoyed this chapter. I look forward to talking to you next chapter when we talk about more um, retirement planning, which is a very important chapter for everybody involved in this class. Thanks. Take care.